Welcome to the Cashflow Project podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cashflow Project podcast. I'm your host, Steve Quiros with Tri-City Equity Group. Today, we're going to talk about all things cash flow with Drew Breneman. So excited to have Drew on the show. He's actually back in my home state of Texas right now. I know he's not a native there, but he's getting to experience some of our Texas summertime heat. All my Texans out there know Texas is the place to be during the summertime. A little bit about Drew. Drew started Brenneman Capital in 2005 at the age of 19. So he's definitely doing greater things than I was doing at 19 years old. He started that to purchase his own first, rental properties to grow his own personal wealth. But then he's opened up now, long since that, to open up deals to other investors who are wanting to grow and establish their cash flow to grow their own wealth. Brenneman Capital provides services and expertise to other vertically integrated regional real estate firms that he started, Blackhawk and Dwell. And he's been the driving force behind the growth of these companies to source, capitalize, and close on over $175 million of properties across those businesses. And then, of course, executed the game plans to be able to provide those opportunities. I also heard that he was previously a magician. So maybe we can pick his brain a little bit on that. Hey, Drew, welcome to the show.
Yeah, thanks for having me, Steve. Happy to be here. And yeah, you're right with the Texas heat. You got to get everything done before noon, basically, when it hits 100. So, but I'll take that over the winters in Chicago, or I grew up in Wisconsin, so over that any day. So it doesn't sting your skin from the cold when you go outside here, at least. So, and there's no snow to deal with. So
I know I always hear that from other people that I meet that are growing up in the North. It's like, well, you're locked inside for several months out of the year, or you're shoveling snow. We've had conversations before. It's like, gosh, I don't know if I'd rather like that extreme cold or the extreme heat. It's like, ideally you have neither one, but what would you rather deal with? You have obviously made the choice to be further down south.
At least you got the sunshine every day, where that's probably the biggest thing, where in the winter, it's not very sunny up in the Midwest. And then you have there's no good time of day to be out. At least in the middle of summer here, it's fine in the morning. I mean, I took my kid to school. It was like in the 70s still. So, and then it builds its way up to 105. If you do something in the morning, you still got good weather. So
yeah, there you go. You just got to learn how to manage it. As always, you go from air condition to air condition to air condition, or start your day early and do stuff a little bit later too. So very good. Well, for those of our audience that may not be familiar with you and who you are and how you got started, fill us in a little bit about your background. You got started pretty young. Fill us in on your journey and how you got going in the business.
Sounds great. So I got started really young, just like you had said, and I started an internet business when I was in high school, reselling items in video games. And prior to that, I was a magician, like you said, where I was doing kids' parties. That wasn't a huge moneymaker. You would maybe get one a month or something booked, and I was charging $50. So it was good money for the half hour you performed, but you weren't exactly making money while you sleep like you want to be in some businesses. So, but it was fun. And I still can do that where if it's holidays or something in my family, people want to get the deck of cards out and see some tricks. So yeah, I did the kids party thing, and then also started reselling items in these video games was the internet business. And, it just started tried flipping one item. And these are like a sword or a shield or a ring or something in these online video games. And, I spent $10 buying an item, and then I resold it for more. And I just kept doing that over and over again. And over the course of my high school and then into my freshman year of college, I did thousands of transactions. So even if I made like $5 or $10 on each one, I did somewhere in the neighborhood of 10,000 total transactions. So I had made just under $100,000, and just over a 4-year period. So as I was accumulating this money, I started looking into what I could do to invest. And long story short, the light bulb really went off for me when I was reading about real estate investing. So I'm a senior in high school. Like I mentioned, I was growing up in Milwaukee, and I was going to go to college at UW-Madison. And so I figured, okay, when I go to Madison, you got to be in the dorms your freshman year. Then after that, I'm gonna buy a rental property my freshman year and then move into that my sophomore year. So I did that. Got a realtor, bought a duplex, rented out the top floor to some like acquaintances, some friend of a friend's kind of thing, rented out this 2-bedroom unit. And then in the 3-bedroom unit that I moved into, I took one of the bedrooms and then I rented out the other 2. And so I was off and running on my first deal. Just kept it super simple. I wanted to make sure it was cash flow positive, Because as like a beginning investor, there's so much you just don't know. You're reading these books and it's talking about title work and contracts and all this stuff. And I figured, okay, at least as like the level I was at, I could figure out what the rent should be and what the operating expenses should be. And then I know, like, at least worst case, if I overpay or something goes totally wrong on this deal, I can just hold it. And then I'm making, I forgot what it was, but $200 a month's what I remember. It was a smaller deal, $220,000 was the purchase price. But that I think included me living in it. So it was, numbers were good. And so
Yeah.
I figured I'll eventually move out. I can rent out just that whole unit just to some regular, not my friends, just whoever, just hold it. And I ended up buying it right still, and everything went fine. I didn't need to use that fallback plan, and resold it a year later for 270. So made about 50 grand on that, not including, your transaction costs. So, but it was ended up being a really good deal because on that I put about 35,000 down, I think. So more than double my money in a year, even though that wasn't the plan, like to do a short-term hold. It's just, like I said, just trying to focus on cash flow, and then figured out I bought it well. And then I had bought another property a few months after that. And then I think the order of events was I bought one, bought another, sold the first one, then I bought a third one, then I bought a fourth one. This is all while in college. Then I'm graduating and I go, okay, what should I do next? I have already invested all my money. And I know we say this is like the start of Brenneman Capital, but I wasn't calling it that. It was just myself. I was just doing deals and never crossed my mind to take on investors. Now people can invest in our deals passively. But at that time I had not even heard of that. So I figured, okay, why don't I get a job and work for a big developer, see like what some of the bigger players are doing. So I did that. I moved up to Minnesota, took a job at an apartment company. It had like a 30,000 unit portfolio, a bunch of stuff happening. This is in 2007 at the end of the year that I moved up there. So then, you could see the economy, everything was kind of slowing down. So too, I didn't feel like this was a good time to be, depending on what kind of deals you were doing, maybe it would be you have to be shifting to longer term holds or doing something different than I was doing. But started working up there and just told my story kind of like how I am now. And I met one of the interns there at the company we were all working at. And he's like, why don't we go talk to my dad? Maybe, he'd want to invest some money in some real estate deals, just kind of do what you're already doing. So went and met with them and printed out a bunch of deals, and they really liked what we were talking about. Just same business plan, focus on cash flow. If it's a commercial deal, longer term leases, so we can get out of this recession we're heading into. And they really liked the $3 million. That was obviously surprising. So because to that point, the biggest deal I had done was 700,000. One of the 3 units was 700 grand. I had just met them, and both my parents, they were teachers too from Mill. So they weren't. I had never met anybody who was like, would have been able to like write the check for a down payment like that. And they could, and we toured the deal and we ended up buying one of the deals we printed out for that meeting. It was a 2 tenant shopping center in the uptown Minneapolis neighborhood, and we still own it. And so we bought from 2009, 2011, we focused on commercial properties. We bought about $25 million of deals together, all kind of similar business plan, cash flow, longer term leases, rents at market. So really kind of cut my teeth, buying these larger deals in the depth of the recession. And then around 2011, I had relocated already to Chicago, the Chicago area. And then we started doing multifamily deals in Chicago. And since then, that's pretty much, I've only done multi. And that's one thing that I realized kind of slowly over time is the more kind of spread out I was getting in terms of geography and different types of properties I was buying, you're competing with someone maybe on that shopping center in Minnesota where that's all they've done their whole career. They've lived in Minnesota since they were born, and they've only done retail. And now you're going up against them, and it's like the third retail property you bought. So we started developing this edge in Chicago with multifamily, just kind of doing the same type of deal over and over again. We were buying these buildings that were built to be condos. Then they went into foreclosure. Someone bought the note, receiver rented them out way below market, just throwing bodies in there. And then we pick it up at like based on the low rents. Then we raise the rents and we keep the property and we do a cash out refinance. So on 12 deals, on average, we've refinanced out would be from 2000 to 2019. We refinanced out over 100% of the equity in those deals. And so really got good at kind of identifying these under rented kind of value add deals that didn't need a lot of construction. Some did, I think 2 of them required like a traditional kind of full renovation, but the rest were more just sort of operational plays, low rents. All those deals went really well. On anything that we've sold, I mean, our average return, it's a 24% IRR, 2.2 equity multiple. And a lot of the deals we sold, though, those were some of the ones where we thought they were weaker deals. Like a lot of our winners we were keeping, like we're more of a longer term holder, just having one investor, if that's the plan. Sometimes if you have a lot of investors in a deal, everyone has a different plan, and then it makes more sense to do like a 5-year hold. But this was more about wealth building and putting stuff into, setting stuff up for the next generation, really, for them. And so we did that. And then in 2019, it was kind of doing the same thing. And actually the son in this duo here that I was working with, the son passed away just unexpectedly in his sleep. So it was a total shock to all of us, and it's still like surreal to talk about. But so I had to make a pivot where our plan was we had $1 million that we were just recycling in these deals, refi and buy another, do another. But that, sort of that wasn't like the dad didn't want to be as active as we were being, kind of me and the son. So then I started for the first time, like trying to see who else would be out there that could invest. Cause until that point, I just only had one investor, and I knew another kind of family, a similar kind of deal, a father-in-law and a son-in-law. And so I partnered up with them. And when you said Blackhawk and Dwell, like those in the intro, so Blackhawk is the name of the company that I started with the folks, the guys in Minnesota, and then Dwell's I started with the father-in-law, son-in-law in Chicago. And so both those companies were kind of the umbrella we used to buy those deals, and then also for property management. So like, for example, then from 2019, 2020, all the deals we bought in Chicago were kind of part of Dwell, and then we self-manage them. So, and this, just to kind of throw some numbers on it. Yeah, I think you had said 175 million. And so it's about 100 million we bought with the Blackhawk guys in Minnesota and Chicago, and then maybe another 75 million at that point in Chicago with Dwell. And when I started looking at all this going, all right, what should I be doing in terms of just this different markets and kind of looking at everything. And the Sun Belt for the last decade at that point, 2012 to 2021, had outperformed the Midwest so much. And I never had like time to step back, but obviously people had some time to reflect and think about what they're going to do in 2020 with everybody being at home. And so I did the same and sort of thought, why don't I mean, I see everybody buying these deals in Phoenix and in Dallas and Austin. And, I did great deals. We did these refinances and the returns are high on what we sold. But then it's like every deal in Austin was making, bigger returns than that, and, has all these tailwinds. And so I thought, all right, why don't I reposition things a little bit to be able to take advantage of that? So now today we buy deals in Chicago still, but also then we expanded into these growth markets. So then we bought 5 deals in Phoenix at the end of 2020 and into 2021, in 2021 and 2022. And then I relocated to Texas this year, and we're getting rolling in Dallas and Austin. So it's a little long-winded. You have to just interrupt me, but yeah, that's what we've been doing. So yeah, so it's been kind of it's been a crazy ride. I remember I was telling somebody I was surprised that I was able to buy $2 million of property in college, where that seemed kind of surreal at the time. Cause I just, in one deal, but then you do well on one, you can reinvest the profits in the next, or do a cash out refi on those. And then this is even, even more surreal, having bought over $200 million of property and still owning most of it. And every deal I was the one who sourced and got it closed and raised, did get the loan in place. My partners already had the equity, so I hadn't done much. I didn't need to do much to raise the equity because we knew what was already there. And then we would all kind of run them post closing together. So it's been a great run so far. So
I mean, it's impressive, man. Did you ever think, hey, I'm going to own $200 million worth of property, and I don't know what your long-term goal is, or if it's just like, hey, no, we're just going to keep chugging along, and I think we can double this, or, we're going to quadruple it or 10x it. I don't know, was that ever I'm genuinely curious as to like your mindset kind of through all of this, because you did get started so young. Like most people are not thinking about that at all. Like I'm just kind of writing down some of my notes here as you're kind of sharing your story. Like the house hack. Okay, awesome. You did that like in college. Okay, cool. Like I think there's, probably a small handful of people that will get on board with that. Cool. I can rent out some rooms, I can generate some additional income. I've got an extra unit there, whatever. But man, yeah, you were crushing it. Like you were like, what was the prompting there? Like how, I know you mentioned
this is what's funny is is I don't need any prompting. I'm just naturally like this. And as I have a 5-year-old son, and I'm trying to get him to be like this, where he just lost a tooth. He got his money from the tooth fairy, and I made a deal with him where he can, if he wants, he can invest it. And
Yeah.
so if he keeps it invested until 2 weekends from now, he doubles his money. So obviously that's like a huge return, but this is just to get him excited about it.
Right.
And he got $5 from the tooth fairy. I don't think he's ever seen a $10 bill, he said. And I will return it as a 10. And so I'm trying to get him interested in that. But somehow I was already like that, where I would have been asking my parents, what can I do with this $5? And then I didn't want to go waste it. I remember when I was really little, I was doing just like a concert at my house for my parents, some like cheap guitar I had or something. And I remember I charged them admission, so I wasn't, it wasn't doing it for free. So I was just thinking about making money. And then, the admission was probably like a quarter or something, where it was, they just laughed and probably paid it. But that's just always how I was wired. So yeah, I didn't need any prompting, and I was interested in figuring out what I could do with the money I had made, where, with my parents both being teachers, they were really into saving. So they had pensions, but then, they weren't, you don't have a high income. Like, there was just a lot of like planning ahead, and at least talking about money that I was able to take in as a kid. And so I guess when I started making some money, I just did the same thing they were doing, where I was saving it, where they were always spending less than they made and talking about saving. And then that rubbed off on me. So even though I wouldn't have any business people in the family, like, that mindset rubbed off on me. And then I still do the same thing. So when you ask, like, what's my goal? I mean, really, I just want to do good deals. Like, the most satisfaction I get is when these deals go really well. The better
Sure.
they go, the happier I am. And it's not so much about making money. I don't even really like spend most of my money. I just keep it for more deals, like, to put in. So, actually I have a 10-year-old car. It's a BMW X5, so it's not a bad car, but it's funny where it's
Sure.
like, it's like, it's nice enough. I think then you start buying nicer and nicer things, then I'll need to get clothes that'll match the car and everything, and a new house to park it in. And, like, so I just try to stop that spending creep. But yeah, I just always was wired like that, is the short answer then.
Yeah, the lifestyle creep. Yeah, no, that's definitely interesting because, like I said, that's not anything that I was thinking about. So I'm thinking, okay, well, hey, you had a solid, solid home. Sounds like, okay, hey, both parents get solid jobs, but they're not like, oh, well, hey, my dad's a hedge fund manager,
Right.
or he's a venture capitalist or something like that, where you're seeing firsthand, okay, large amounts of money moving and that kind of deal. Because to me, when I hear your story, it's like, man, one of the key things here is, dude, you're making big jobs. I do a ton of networking, and like I mentioned, okay, hey, you picked up that first house hack, and you got another one and rolled that to maybe to a third one. Most people still, like, it's a big jump to go, like, let's say, to commercial, right? To go from residential to commercial. So, but you mentioned that first one's like, oh, it's a $3 million deal, and it's like, okay, like, that's
Yeah.
a big mental jump, I think, for a lot of people. But it sounds like, yeah, you're just knocking down the walls. You don't have any problems with that.
Well, I don't think that I think I just take like a realistic assessment of what it would entail. And I look around at like the other people that have bought, a 2 tenant shopping center. And this isn't like a brain surgery. It's more complicated
Mm,
than the house hack, for sure.
sure.
But it wasn't like I couldn't figure it out.
Right.
I'm going to have an attorney cover all the legal stuff. Yeah. At that point, I had never read a commercial lease. So I read both leases in their entirety. So like 60 to 100-page leases, more than
Mm,
once. And just to make sure I understood everything. Like, and I still do that on most every deal. I've read every loan document in full, except if it's like a rinse and repeat the same Fan Mail or Freddie Mac loan docs. But then I'll just get a track changes. But any deal that's got a lease or anything, I read the entirety of it. So I don't know. I just figured I'd be able to figure it out. And some of the people that are doing this, they're smart, but it's not something I can't get to as well. But also, I wasn't overconfident where it was like, okay, I know I can do it. I don't need to read the leases, and I'm sure this will work out. Like, I was really careful with the attorneys we picked, the lenders we used, reading everything. If I didn't understand anything, I always ask. And then pretty soon you know how everything works because you've asked. So
right. Yeah. And that's a great thing, right? That's a valuable lesson in and of itself, right? It's like, well, hey, like, don't be afraid to ask questions, right? It's like, okay, hey, it's the first time I'm doing it. Cool. Well, I expect to do it more times. So let
right.
me understand it. Let's digest the leases. Let's digest the contracts and the material. And after not too long, you're familiar with it. You're familiar with the verbiage. You're familiar with kind of the flow of things, right? And it becomes easier for sure.
Yeah, you need to ask questions. And I talk to a lot of passive investors now because, like I said, in
Mhm.
our deals we buy now, we'll have
Right.
people come in, they'll put 50,000 or 100,000 and invest in a deal, and they don't do this for a living, so they have a lot of questions,
Right.
and a lot of
Yep.
them are always saying like, "Hey, I have a dumb question," or "I have this or that." It's like this isn't a dumb question. Like if you own an unrelated business or you're in a doctor or something, like why would you know what a cap rate is, or some of
Right.
these other terms, the expense ratio? How would you know that? And then if you should ask, and then once you understand, you can evaluate these things better. So so yeah, I was never afraid to do that, I guess at any age, and still do it. And I'm sure I could tire people out with all the questions. So sometimes. So
No, that's great though, because I mean, we raise capital too. I mean, that's just part of the business. It's like, hey, look, you're an educator, right? Like you're helping them to understand what it is that you can help them and offer them to help build generational wealth, right? So, they're not going to be familiar, and if you're the shoes on the other foot and you're going to the doctor, hey, I need you to explain this to me, right? Like I'm seeing you for this condition because you're the expert here, right? Like I'm visiting you in your office. Like tell me a little bit about, what it is that you're seeing, right? Like help me to understand that, right? So yeah, no, I totally understand that for sure. Uh, you know, uh, you mentioned, obviously you guys are in different markets now. You mentioned doing property management. You guys are keeping that in house. When did you decide to go vertical where it's like, okay, well, hey, look, we're obviously buying in different markets. Okay, now you need different teams and, boots on the ground and all these different places. When did you decide where it's like, well, okay, were you hiring third party, before, like to handle this stuff, or has it always been like, no, we just manage it like all at the same time?
it's been a mix, I'd say, where we starting out the very, very beginning, I managed every property myself, even the ones in Madison, like all those I just managed myself till I moved out of Madison. And then when we were in Minnesota, we applied the same thing. We managed those properties ourselves. We still do. That's something that my partners always did, where they picked up that part, where they invested the money, they did the management, and then I had the deals and could get them closed. And so Minnesota, that's always been self-managed. Wisconsin, I sold all those eventually. And then Chicago's been this kind of a mix where we started out self-managing the first four, and then it was just me here. So then it was too much for just me to do and not big
Mhm.
enough to hire somebody else full time at that point. So then I think the next six or so, we went third. Let's see. Yeah, we went third party with those. And then I started buying with the Dwell guys, which were local to Chicago. And then for the next however many we bought, 8 or 10 deals. I own 16 right now total in Chicago, but I don't have the breakout memorized on who are managed by who, but we have four of those are still third party managed. So then, but then 12 we manage ourselves either with Dwell or just Blackhawk. And then Arizona, that's all third party managed. That's been my experience where if you have the time and can learn everything slowly, like then sure, self-managing makes a lot of sense. But it's also okay, I feel like, if as long as you are able to get similar result through a third party, I mean, you are saving a lot of time, and they also know all the rules and the laws. And
Right.
that was something why we went third party in Arizona. I mean, all the rules are different than in Chicago. And then we're trying to focus on executing the business plans where two or three of those needed renovations. And like there were just a lot of moving pieces. So we figured at least let's
Right.
make that more simple. And then I think Texas, we'd start out the same way. Like we'd third party manage. And then as it's bigger and you could go, okay, hey, we could hire a similar team and bring it in house, then maybe that makes sense. But I would say, that only if you're not getting what you feel like is a good enough result. And I think in
Mhm.
Arizona, we're getting a good result. We had to switch management companies a couple times, but now how we have it
Right.
set up, unlike the smaller deals, the deals that are under 100 units, we've got a company that we really like, and then one for over 100, we got a company we really like. So, took a minute to get everyone in the right spot, but we're there now. So,
Yeah, I was going to say that usually comes from either because you had a management background, right? Like, oh, okay, hey, one of a partner or something like that. Well, we already have, a management team or a company that we can kind of incorporate into the business, or like that. It comes from growing pains, and it's like, okay, hey, I'm self-managing. This is too much, or whatever reason, and it's like, oh, we got to bring somebody else on, or that flips, right? Hey, we started with third party, and it's like, no, we're going to bring it all in house because XYZ, because we're running into
yeah.
challenges.
And
So
there's
it's just
actually
interesting.
there's another category that I never realized, but I have on my podcast, I had one of the gals who works at the management, one of the management companies we were using in Chicago. And I said the same thing you did. And then she said, and there's owners who have no business managing their own property, where they hear what the laws are, they don't follow them, they think they don't need to clean the hallways or do repairs, and or they don't have time to do it. So someone says my air conditioner is broken, and then they let a week slip by. So then there's a different, breed too, where it's not as much about, okay, hey, I'm driving this business plan, I need to get the 10 out of 10 result. This also, there's a subset where it's like they're doing and don't care to learn. So and then those are the best, the people the most, I found out. So
Those are the ones that slip to like the slump lord.
yeah, well then they end up
Sorry.
doing that if they manage it themselves, so
Right.
then hopefully they can get it to like a professional company, because they're not striving to be professionals. They're just going, I put in some money of my own or my buddies, and yeah, I'm running it however I can, but I also want to go golfing on the weekend and not show units. So then I'm this unit sitting empty, and it's not going well for them. So there's another group too. So I've never fallen into that camp.
Well,
I've
yeah,
fallen in the working too
doesn't sound
much
like it.
camp.
I
So
was gonna say, and if you're a passive investor, like that's not, that would steer away from, operators like that too, right? Like it's like, okay,
yeah,
if
for
it's your own
sure.
if it's your own money and whatever, like okay, cool, that's your property, do what you want with it. That's definitely one of those things where you're raising capital, then yeah, we need to put some care into
Right.
into operations and all that. So that's good. Well, you've obviously been through, because your career, even though you're a young guy, I mean, your career is spanned a couple of market cycles already. I mean, you started so young. So, now that you've been through a couple of cycles, like where do you see, the current, environment affecting operations, debt, all that kind of stuff? Like, how do you see where we're at and kind of projecting even going forward? Like, has that changed any of your business model or, what you guys are doing, like to kind of flow with?
That's a really good question. I think what I realized in 2009 and 10 was, and there were these deals where maybe you just really, you don't know how long you're going to hold them, what the exit's going to look like, but the cash flow was really high back then. We were buying
Mhm.
those commercial deals. Those were probably, our average cap rate on those deals was a 9, and then we were borrowing at 6. And
Mhm.
you put 25% down, and that was generating like a 16% cash on cash, paying your loan down another 8% kind of equivalent in terms of, so you're making over 20% a year if the thing never went up. So our pitch then was like, we're just getting paid to wait. We're buying nicer, newer stuff with rents that are at market. We're getting paid to wait. And that strategy ended up working out great. Eventually cap rates fell, for those kind of deals, like into the 6s and 7s. And then so we made over, 20% a year, because then we also got some appreciation. But
Mhm.
I'd say I see kind of a similar setup today as that, except the cash flow right now is very low in these deals. So meaning, okay, if you bought a deal 2 years ago, and most likely the prices have gone down, depending on what kind of property, where it is, anywhere from 5 to 30%. So just looking at it as simple as you can, as simply, let's say you're buying something that's 20% cheaper than it was 18 months ago, and you're going to own it for 10 years. I mean, that's going to end up turning out well, because you're buying it on the dip, and then I don't know if there's any period of time, I haven't looked, but I've always assumed there's not, like over a 10-year period where real estate prices went down.
Right.
I'm
Yeah.
sure in some markets, like if you
Sure.
look at a certain decade for Detroit or something, or I don't need to beat up on other cities, but just so it's whatever, they may not have gone up, but for where we're buying in these really nice neighborhoods in Chicago and these growth markets, there's not going to be a 10-year period where prices went down, and you're already buying at a discount. It's hard to make sense of it right now, because maybe you're buying at a 6 cap or a 5 something cap, and your interest rate is the same or slightly higher. And just to get any decent cash flow, you're going to need interest rates to drop or your rents to grow a lot.
Mhm.
So none of the deals feel exciting, right now, except for 2 we have in Chicago that are coming up, those are like going to stabilize at a 7 cap, and then we're borrowing one, we're assuming a loan in the 4s, and then the other
Mhm.
will put a new one on. So like, unless you can find a really unique opportunity like that, where there will be cash flow, if you can get that kind of spread, but all the stuff we looked at in Texas and in Phoenix, we haven't seen that. And so it's more like
Right.
no cash flow, very little cash flow, but then there'll be like a pretty large, residual, when you sell. But it's hard, it's hard to kind of see what changes. When do cap rates go down? When does the rent
Right.
growth pick up to get to? But that just always happens. So I mean, how I can see it playing out is, let's say we're in 2023 right now, 2022, and in 2023, with interest rates going up as much as they did, at least on the multifamily side, new supply, like new projects starting, it's basically none. It's ground to a complete halt because the interest costs exploded up on everyone's pro forma, and then you got to stabilize to a much higher yield on stabilized cap rate when you finish your to have any decent equity returns. So no new projects are starting. So then what does that mean? By 2025, no new apartments coming. And I say none, I mean, there will be some, but when it'll be
Sure.
record lows of new apartment deliveries in all these booming cities, in Phoenix, in Dallas, in Austin, and Nashville, and just everywhere, what's it going to do to the rents? They're going to be exploding upwards unless we have like a big recession or pullback
Sure.
in employment. So, I mean, so I can see this setting up where the people who buy now, at the time, it seems like that deal doesn't seem that great. You know, their spreadsheet says they'll make a 12% return, where they could look like geniuses in 3 years if this happens, where no new supply comes, rent growth goes through the roof, and then all of a sudden interest rates normalize. We calculated what the average like 5-year treasury yields were over different time periods for the last 5 years, 10, 15, 20. They were all in the 1%, and then you put a normal agency spread on that. I mean, that's rates like around 4%. So like your kind of historical 5-year fixed rate mortgage on these kind of deals is like is 4%. If it goes back to that, you get your rent growth. I mean, these deals, they'll all look amazing. That's not what
Right.
we're underwriting. You know, we still are
Sure. Yeah.
assuming when we refi, the rate will be in the fives, and we don't do 10% rent growth. Like we're doing 2.5 or 3, depending where it is. But if you're asking how could I see this play out, I could see everybody who bought now and it seemed like, okay, the deal seems okay, but they're buying it 20% cheaper than a couple years ago, looking like geniuses in 5 or 10 years. And then
Sure.
everyone's seeing, yeah, it seems so obvious that rents were going to explode in 2025, 2026, and then rates were going to drop because, you know, I mean, hopefully by then we're done fighting inflation and back to normal, right? And so so I could see some version of that playing out. So if you can make
Mhm.
sense of a deal, I mean, this is just buying low essentially. You know, seems
Yeah.
like prices kind of stabilize where they are, where I, you know, felt like the last year and a half, or like every couple months, the cap rates were a little higher. I feel like that hasn't happened since the spring. It's been pretty stable, like
Mhm.
the pricing. So we might be finding kind of our footing here in terms of a bottom. Maybe it's just a bottom for now. If something else happens, you know, the drop off in rents or employment or another war or something. But that's how I could see it playing out. And so I mean, I'm bullish. It's just hard to make some of these deals pencil, but on the ones anything we buy, I'll be really excited about kind of the upside case, because that's what happened to me in 2009 and 10, where I bought thinking we're buying this for cash flow, and then
Mhm.
cap rates dropped and our rent started growing a lot. And, you know, a lot of those deals, we, you know, like we 3 and 4 timed our money on them. Yeah, so they turned out way better than we thought. So
You're like, exit, please.
yeah, yeah, and but also the, you know, think about long-term holds, like holding
Yeah.
longer. That's another thing too. I just kind of glossed over, but a lot of these, I was fortunate the partners that I had, they wanted to do long-term holds. So we've been able to build a lot of wealth, you know, and not be just owning things for a couple of years. You know, our average hold is probably 8 or 9 years at this point.
Mhm.
You know, on the ones where we're syndicating, have a bunch of investors in them. I mean, I think that's going to be more 5 and 10-year holds, but
Sure.
it's still not going to be like these 3-year fix and flip kind of things. I think there's so many moving pieces on that. And really, if you think about like how these families that are in these big cities, like the ones in New York or Chicago has a bunch, where how they made money in real estate, it was just owning good locations
Yeah.
long term and not doing anything complicated. And so we're trying
Yeah.
to do our version of that.
Yeah. I tell people that all the time. It's like, look, if you put everything on a long enough timeline, even you just hold, I mean, with all the, let's say, devaluation of the currency, and if you're in a good market, like, I mean, just, it does what it does. Like, you can't
Yeah.
help but to win, but you have to have that kind of long-term perspective. And it's great that, like you mentioned it too, the partners that you have, well, hey, I'm not looking for a quick exit. I don't need the money right this moment, right? Like if you have that long-term vision, look, we'll all win together. Like, but
Yeah.
you can get there, so.
Yeah, you're right. Yeah. And I always do this thing where I think about if I were to put, let's say, you know, let's say you put 20% down on a deal, and let's say it's a $5 million deals for round numbers. You put 1 million down. I always think to myself, if I don't do anything, like over the next 25 years, 30 years, let's say this property will double, be worth 10 million. I'll have it paid off. And this assumes no cash flow or anything, no moves. You didn't sell it and buy a bigger one midway through. Your 1 million turned into 10. And that's assuming no cash flow. You didn't do anything. Like that's 10 times your money in a 30-year period. That's pretty dang good. And that's if you do nothing. Like there's no cash flow, and there will be, and you can make moves in the meanwhile to do
Sure.
better. You could have sold it after the 10th year and bought one twice as big. So I like to keep things pretty simple sometimes, and I like that as a business plan. So I think, so we'll be, the deals we can make work on today's numbers, we definitely are bullish and want to do, and then those will be 5 and 10 year holds.
No, yeah, and I was before you said it, and you've mentioned it a couple of times already, but yeah, I like your approach of just like, hey, I'm not going to overcomplicate it. It's not rocket science. I mean, some of the moving parts, I mean, you just have to know what's going on, right? Because it's more complicated than say a residential transaction or a residential hold operations and whatnot. But yeah, you keep it simple. Like I don't need to know like, okay, I've got friends, they're traders and
Yeah.
you got all the quantum, computing and, all this stuff that's involved now. And it's overly complex. And I'm just like, well, it's actually, it's pretty simple.
Yeah.
And,
No, I know. When I
it's,
was living in Chicago, I'd meet some people who worked at Citadel, and I'm always like, this is where they're winning, math competitions and stuff.
right.
And that's like, well, I got good grades, but I wasn't in any worldwide math competitions or whatever. So you don't need to be for real estate if you're going to do it long term. So
I was
just
going to
need
say, and
this.
you
Yeah.
bought $200 million and $200 million in real estate. And so that's the thing. Like, that's awesome.
Yeah, a lot
Well,
of credit to my partners and investors on that, where, that's kind of, I was finding the deals, but I always had the equity or was able to raise it. So you got to deliver, have a good track record, be finding deals. But it's, if you got no one believing in you, or you can't somehow meet the right people ever, like that'll, like a lot of that's, due to them as well. So.
oh, for sure. It's a team sport, right? Like that's the thing I've understood, like working in the commercial space versus like residential. You can be a lone wolf, like doing residential stuff. But once you kind of step, over into the commercial space, like it's now nowhere near as easy to do, especially at any kind of scale or at speed. So yeah, no, that's a huge, it was a huge learning lesson for me personally. Well, awesome. Well, Drew, it's kind of the point of the show where I want to transition a little bit into our kind of our fire round. It's a little bit more rapid fire, just a quick answer. I mean, I definitely feel like I can talk to you, much longer on this stuff. And I love your approach. Like I said, the approach is like, hey, slow, steady, not overly complicated. We're going to do what we say we're going to do. We're going to keep it, solid in solid markets. Like it's not okay, hey, I've got to go, create a blue ocean somewhere else. It's like, well, look, it's just tried and true. Like people have used this over and over and over again. We just have to do that. So,
Yeah,
um,
it's a good risk adjusted way to go through everything. But yeah, let's
yeah.
fire away.
All right, right on. Well, first question, what is the best book that you recommend other than Rich Dad Poor Dad?
Good to Great by Jim Collins.
Great
How
book.
short of answers do you want? Do I say why,
No,
or you want?
that's
It's
good.
okay.
You can
If
you
you,
can expound on it. Yeah, if you
I
like.
mean, he goes into what separates a good business from a great one, and just kind of how he breaks down, why did Southwest, let's say, airlines outperform these other airlines? What did they do? And there's so much that I've learned in that book that he's got other sequels to it, and so that whole series of books, some of the best stuff out there.
Yeah, I think that's it's just a great mindset, right? Going from good to great. Okay, well, what does that take? And well, it's like, I got a good life. Okay, but do you want great? You can have great, and what it takes. You're right. It's a lot of nuance and details in there. Okay, next question. What would you consider your superpower?
I would say seeing the bigger picture and not being afraid to take a chance. So I know we talked a lot about like long-term thinking in there, but part of that, we're not getting to, when you say, well, you're doing a bigger deal, what were you thinking? And I wasn't, let's say, that nervous about it, because I was seeing like kind of the bigger picture where, okay, you have the equity to buy it. You bought something that was similar, maybe just not quite as big, and what could go wrong, and just kind of seeing it more like zooming out from the situation. And then I think about, okay, well, okay, then if think this part could go wrong, let me spend more time on that. But yeah, kind of zooming out. That's been a way to, it's helped a lot.
Yeah, that's good. What's the biggest lesson that you've learned over your career thus far?
To learn by doing. So one thing too, we, kind of everything we had talked about, where I have a degree in real estate. On my undergrad college degree is in real estate, but there wasn't any classes on raising equity or how to actually acquire a property. It was more like, here's the laws and here's some finance stuff and real estate 101 type topics. So
Sure.
really most, 99% of what I know today, it was just by doing. So I never did a mentorship or boot camp or any of that kind of stuff. I'm sure that would have helped speed me along, but I just did it all, just kind of one deal at a time, asking questions. So you can do the same thing, just learn by doing.
Oh, that's awesome. All right. And for the busy working professional who's trying to work towards, financial freedom, like what advice would you have for him?
Well, I think you should kind of choose your path. So either, think either I think you should just invest passively and just kind of enjoy, enjoy your time, so to speak, and not overcomplicate your life, or go all in and decide you want to be an entrepreneur. And if you're going to do that, like then you know, change, if you're trying to work towards financial freedom, you can achieve it just kind of passively investing and just doing, some more things than just the stock market. Or if you want to be an entrepreneur, don't try to do them both. Like where you gotta eventually make a pivot and go all in on being an entrepreneur. So that would be my advice. Pick a path. So
Yeah, no, that's good. And like that, I think that's gotta have, that has to have attributed to your success because you made that decision long ago, right? To go that route. And you've just been able to focus on that like throughout all of this time, right? And that's helped to contribute to
right.
your success in a
And
big
it, and
way.
if I
So
was like 50 years old right now, and I was just going to start, I mean, I probably would say I already built this nice career. I don't want to, I don't want like the whole idea of like investing or financial freedom. Like it isn't to now I have two jobs. It should be where
mhm.
you have one that you can like, kind of scale down at some point. So that's why I was, if that made sense, where it's like, don't start, too many things and not doing well at any of them. Like, just focus on
Yeah,
your main thing you got and invest passively, or go all in on being an entrepreneur. Just know the going all in on entrepreneur, that's going to be more work than the W-2 for
yeah,
a long while, but good on the other side. So
yeah, yeah. Much higher ceiling. I would sort of tell people all the time, it's like, well, it's got a lower floor than having a W-2 job, that's for sure, but way higher ceiling than
right.
anything you'll find at any high paid W-2. Like that's doesn't even matter. All right, right on. Well, awesome. Well, if our audience wants to, reach out to you, they want to learn more about, you got your podcast, if they want to, download your guide, how can they get more information about you, book you for a, magician show, for their kid? No, I'm just playing.
The kids parties, those are 10 grand now. So no, I'm just kidding. But they are, yeah, go to, yeah, that, I mean, maybe I'll come out of retirement for that. That's, I'm just kidding, but that sounds good. But yeah, Brenneman Capital, our website's brenneman.com. So if you want to invest passively, if you like kind of what we've been talking about, we got a good thing going for multifamily deals in those markets. That's all we do. And 80% of the deals we buy are off market. So too, not stuff where we're like the highest bidder out of 20 people. And then I do have a podcast as well. It's called the Brenneman Blueprint. That's a real estate investing, and so you can check that out everywhere podcasts are and on YouTube. And then social media, I think I'm on every platform at Drew Breneman. I mean, most of my social media stuff is just a lot of podcast clips and different things. So I'm not doing much
TikTok?
influencer stuff. I did make a TikTok. Actually, my sister worked at Kendra, a jewelry company, in social media, and their best platform is TikTok. And she's like, you got to get on it. And so I did. And that's just more podcast clips. But yeah, you can do well. You can get a lot of eyeballs. I'm not sure if it's the eyeballs how old they are. I just have a big demo and the 14-year-old business kid or not, but
Future
I got
educational
that at
piece.
least. And it's easy to do, and hopefully people are learning stuff. But yeah, and also too, if you're a passive investor and you want to learn, we have that guidebook you're talking about. You can just go to our website. It's on the downloads page, and it's 100 pages. And don't try to read it all at once. More meant to, it's like it explains how the waterfalls work, or as a glossary of a ton of terms, or what the risks are involved, or how the tax benefits people talk about work, the benefits and disadvantages of different product types. So, just kind of everything you'd ever imagine, correlations with the stock market and bonds, and just everything's in there. So check it out.
Awesome. Well, Drew, thank you so much. It's been an awesome show recording with you and just having our conversation and time with each other. So I really appreciate you spending some time, taking some time out of your day and sharing with the audience as well. I've learned a lot, and then, I hope to apply even some of our conversation, to my own personal investing journey. So, but thank you so much. I will let
Thank
you
you.
get out to enjoying that Austin heat and hopefully some great Austin barbecue too. I miss my Texas
That's right.
barbecue. I will say that.
That's right. Yeah.
So,
No shortage of good ones here. That's
yeah.
got their barbecue.
Yeah.
So yeah, thanks for having me on. I appreciate it, Steve. This was fun. Thank you.
All right. Absolutely. Have a great one. Aloha. All right. Great show with Drew Breneman with Brenneman Capital. And obviously he's got his dwell in Black Hawk as well. Great show. I love his approach to investing, keeping it simple. Obviously he got started really young. So just want to encourage you guys that are, in college or, kind of just starting out. gosh, you're never too early. You're never too young to pick up some skills. I love his mindset of, you know what, the best way was just to learn it, just to do it, right? Choose your path. And really, you're going to learn the path that you want to take by getting out there and trying and learning some different things, right? House hacking. Then, okay, well, hey, I'm going to rent out another unit. So you learn property management, you learn property maintenance just by having your own place. So great skills to pick up. And then obviously he scaled up with the power of partnerships. I meet a lot of investors that are reluctant to take on partners. And I do understand that, but there's definitely a time and a place. And so if you want to get to a point where you can do it quicker and you can also leverage, different people's skill sets, right? You have your own life experience. Other people are going to have different skills and their own levels of experience that they can contribute to, a partnership. Obviously you want to vet them, but partnerships are incredibly powerful. And then especially if you're going to bring on, outside capital or experience or, net worth, if you're going after, let's say, commercial deals, you're looking for, you need to check experience boxes and net worth and all that kind of stuff for taking on some of this larger debt. But yeah, he had some great experience and, obviously a very experienced investor himself. Had some great recommendations, Good to Great. Jim Collins, of course, that's an awesome book. If you guys haven't read that one, that's a great read. And then his superpower with seeing big picture. His view on looking and thinking long-term, I think is something that every investor should have. I know a lot of flippers, investors put everything on a longer timeline. Even if you're flipping and you're making great money, which I know a lot of flippers that do, still want to think long-term, right? That's still not wealth building. That's more still income generation. You got to park that wealth, that cash somewhere that's going to serve you better than just, hey, short-term capital gains, just, always just having active income. You want to eventually build wealth, park some of that in some longer term holds. And they're doing even longer term, even than I think most investors think, right? They're thinking, okay, hey, look, I'm trying to create generational wealth. So this is not going to be a 2 or 3 year deal. This is going to be something it's going to be a 10-year minimum hold that I'm looking at. So I love his long-term vision. And then again, choosing your path, right? And we kind of touched a little bit about that earlier. But yeah, awesome interview. Definitely make sure you go check out his podcast, the Brenneman Blueprint. And then you can also check out his site or any of his socials if you want to connect. If you want to connect with us, a little bit better, if you're interested in investing with us, go to trustedEquity.com. We're always working on deals. The team is always underwriting. We have some currently, but make sure that you're connecting with us if you want to stay up to date with the latest opportunities, connect with like-minded investors. Go join our Facebook group, Honolulu Multifamily and more. Well, it's a tongue twister, it can be. We meet up every month. If you're on island, you want to connect with other investors, whether, you're experienced, you're just starting out, or you just have questions about investing, come on. It's always important to meet with other people who are going the direction that you want to go, or that you can pick their brain and ask questions about. And if you guys found value in this podcast, of course, please subscribe. We'd love the subscription and a great 5-star review. If you found value, if you didn't find value in it, hey, you know what? Leave us a 1-star too. That's all right. But let us know how we can get better, because we'd love to be able to provide as much value as we can for you guys. All right. Well, that's going to be it for me today. Steve Fierro signing off for the Cashflow Project, and we will talk to you guys next time. All right. Aloha, guys.